couple of people out there who think about things the same way we do. In the financial world, I'd like to introduce Sena and Michael Rubenstein to the stage. Now, Ken is one of those people who thinks in the same way we do about patterns and evolution. He writes about how different industries are similar. And here to talk about the future is Michael Rubenstein.
Great. Thanks, Brian.
Thank you.
And welcome, Ken.
Thank you very much, Brian.
So as Brian mentioned, Ken is a managing director in equity research group at Evercore Partners, and he covers consumer internet companies. He speaks to institutional investors all day, every day, about both private and public internet companies, including ad tech companies. And he's here to help share with us how investors and the market think about what we all do, what creates a valuable company, and how new factors like mobile change the game. You may recognize him from his appearances on CNBC and Bloomberg, and we're really thrilled to have him here today, so welcome, Ken.
Thank you, Michael.
So, tough act to follow. But you and I were talking about it beforehand, and with the exit surveys, we're very committed to this session being the top-rated session of the day.
Go big or go home.
Go big or go home. And we were doing one-arm push-ups outside before this. And are you ready?
I'm ready.
Okay.
I've been studying for this for a long time.
Okay, good. All right, great. So let's talk for 15 minutes or so, and then we're going to open it up to you as well if you have any questions for Ken. So let's start with a reality check. As I mentioned, you talk to investors and the market all day, every day about public and private companies. We in this room, in this space, always love to drink our own Kool-Aid. So where is the reality? Do people out in the market get what we all do?
No. I think that we're still in a process of determining, I think, for most public investors, how important is the ad tech space, how important is it for them to study and invest in. And I don't know if this mic is maybe a little bit high. Do you hear an echo here? Just pull that down. We're good? Okay. And I think that Terry Kwaja, who will speak later today, his illustration of the space, I think, tells a lot. And I think a lot of investors could look at that and say, this is actually kind of poking fun at an industry. Why do we need quite so many point-to-point solutions? When you look at that and you think there has to be some sort of consolidation, are they all going to be absorbed in terms of strategic buyers, or how many of these are ultimately going to go public? And I think there's a certain degree of skepticism still on the part of most public investors. Now, I speak mostly every day to public investors as opposed to private investors, so Dave and TCV will obviously know this space a lot better than most investors I speak to, but I think it's important to be aware that we're also speaking to media investors, not just investors more broadly. So, but as you go up more senior within institutions, hedge funds, et cetera, their focus tends to spread beyond just technology companies and ad technology companies, but into broader sort of TMT verticals. And so I think that it still will be a challenge for a lot of you, I think, in the audience to kind of get that message across to those investors in simple terms.
Well, paint a picture for me. I mean, the investors you talk to, what percentage of them would know what, for example, RTB is?
About 10%, I'd say.
Okay, and maybe DSPs, SSPs, a lot of the terms Brian was talking about before?
Even less, I'd say that it'd probably be TLA would be is what they're going to hear when we start trying to talk about those terms.
So is it a problem, and what specific things do you think this industry can do to tell a better story?
I think it's important to be able to explain, I think investors understand very well from a customer standpoint what the value is that you're trying to add. They look for things like large addressable markets, which most of you are served within. They like margin leverage. So there are a number of you that tend to book net of your traffic acquisition costs. It tends to be more akin to a software model. They like that very much. The hard thing, though, for them is to understand really what is the competitive barriers. And that is really what matters most when they're thinking about forecasting the overall opportunity and how much of that opportunity ultimately gets retained in terms of margin leverage. So I think that is probably the trickiest issue that I think many of you in the room would potentially have to explain.
So let's go back for a minute to this net versus gross booking, because this is kind of an issue in the industry in general. I think you've got companies who report on gross versus net. What do you see?
I really, some people will say to me, do investors even get kind of the gross versus net? I think they absolutely do, but there is a certain kind of lazy investor too that you have to be aware of. And sometimes they'll just say, look, the revenues are growing by X. That's obviously going to mean margin leverage down the road, and so be it. But I think usually what happens is when you start talking about net versus gross, there's a certain number of very savvy investors who will zero in on an issue like that and say, there's a markup here, that markup needs to be corrected and basically squeezed out by the marketplace. And so I think to save yourself the time of potentially trying to go through that conversation with investors, it's best to sort of neutralize it. And if you do book it gross, great. A lot of times there's accounting requirements that mean that you need to do that. But give the investor, I think, the credit, the benefit of the doubt. Speak in terms of maybe gross profit and maybe your margins as a percentage of gross profit, so they can really sort of sense what sort of margin leverage you ultimately have.
Okay. So you touched on something a moment ago, which is what creates a valuable company. I'd love to drill in a little bit on that. So from your perspective, when you look at companies, what are the key drivers of value, creators of value?
I think again, it would be total addressable market size, margin leverage. You can see certain companies like LinkedIn, 90% gross margins. Many of the software companies have similar gross margin structures, and strong competitive barriers. Whether that comes from kind of a consumer audience dynamic, a marketplace dynamic where you're able to basically satisfy the needs of both buyers and sellers simultaneously. Anything that ultimately can mean that maybe the growth of scale ultimately benefits each of us as a member of that experience. And I think that's something that is hard to necessarily define for many companies. Why does, just an example, Facebook, if Facebook goes from 1 billion or so users to 2 billion users, how does that benefit me as a user, right? There's a probably clearer example with LinkedIn, because you could say, I'm using LinkedIn to potentially hire new people, to reach client contacts, to think about how I could be doing my business better, and these are people I don't know, but I need to know them, right? So the size of that scale, that is actually very important. So thinking about that in terms of whether it's network effect, marketplace dynamic, whatever you want to call it, we spend a lot of time actually in this area studying, because they're very low switching costs for most technology companies, for most internet companies. And so that means there's a potential for a lot of disruption.
So you talked about gross margins and LinkedIn, 90%, TripAdvisor, 100% gross margin. What is a high gross margin?
I think anything up in that range is very high. It's very attractive. But I think for many ad tech companies, you're probably dealing with a pretty wide range, because depending on how you book your traffic acquisition costs, you might be looking at margin leverage, which could be, if it's a percentage of gross, maybe it's managed services or whatever, you could be looking at low double digit, maybe low to mid, but it does make it harder to sort of drive that ultimate bottom line and show that leverage.
Do you think of ad tech companies as internet companies, or how do you?
Truthfully, no. And I think that I get asked this question a lot, like, what is an internet company today? Because it seems to bleed in and out of almost any industry we deal with. And increasingly, I think internet companies clearly have an audience scale that has been created through the web. But really what makes an internet company today is, I think, the ability to use that scale to ultimately drive either leverage through rethinking the supply chain, and you're seeing examples of that with an Amazon or a Google, going into OS, hardware, et cetera, or they're able to somehow use that scale that they have to satisfy multiple groups simultaneously. Maybe it's a customer set, it could be consumers, it could be sellers, it could be developers, it could be users, right? And I think being able to balance those needs of multiple constituencies give you a certain stickiness, because you really have to see one set of users leave the platform before the other set of users leaves the platform in order to see that potentially unwind. If it's just scale for the sake of scale and you're not doing those other things, then you are potentially at risk. And I think mobile adds an extra risk element to that.
And why does category matter, and how do you think ad tech companies or internet companies in general are most generally valued?
Well, they sort of fall within internet just because the biggest users of ad technologies today, the publishers, the advertisers, though they do tend to fall in internet, right? And they fall in digital media, which typically is a part of overall internet. And I think that we find ourselves probably in a position to be able to maybe support clients better in terms of the needs that they might have about how these businesses are adding value to their customers than maybe some of your traditional sort of software analysts. And I think from that perspective, you'll see ad tech probably followed more by internet analysts than maybe by software analysts. But again, when I think of internet companies, usually there's a similar characteristic in that they can draw from a strong consumer audience. I think what makes LinkedIn an internet company as opposed to a SaaS company, even though all of its revenue streams are mostly derived through enterprise, is that it has a data layer. It has an audience component, which is basically kind of a wind at its back, which typical enterprise players would not have. And I mean, that's in part my argument for why I should be covering LinkedIn versus our software analysts. But I think it actually works. And ad tech on a sort of by that definition, should be an enterprise business model. And I think that in that case, it would be covered more by your software analysts.
Okay, and let's talk about how it relates to the public markets, right? Because you've mentioned this a bunch of times, and obviously there aren't that many public comps in the ad tech space. You've got ValueClick and others out there. It kind of feels like there's been a rush, or at least some discussion about, ad tech companies or different internet companies in general rushing to IPO. What's happening there? Is that a good thing? What advice would you give to companies?
I think that it's investors will feel that potential motion of companies probably approaching the window. And as they do, they're going to be asking the questions that we were just discussing about competitive barrier, et cetera, et cetera. I think you certainly could go public under sort of the brand of ad tech, and it's certainly going to help you in terms of the story, I think, early on. But I think it'll only help you for a period of time. I think then investors will ultimately press down and say, okay, well, really, where are those competitive barriers? If I don't see them, there's the opportunity to see what happened to your stock the way it happened to Millennial. For some investors, that's good enough. You still sort of get a nice run, and whatever happens after that is fine. But I think investors are wising up, not just to the situation maybe on the enterprise side, but also if you look at consumer tech companies that went public recently, and you had many who kind of went public under the sort of the guise of social media. And I think you've had LinkedIn obviously rise to the top. You've had Facebook become fairly impaired, and Groupon or Zynga, who kind of considered themselves to be social and having all sort of the powerful capabilities around data, et cetera, proved false. And so the benefit that those players, though, would have potentially versus ad tech is that they do have more scale, they do have more liquidity, and I think that means that investors sometimes will take more time to want to learn the distinctions between them. With an ad tech, it'd be probably a little bit more of an uphill battle because of the fact that you are dealing with smaller market caps. But I think for those investors who do focus on this area, they're going to have the same approach. That whether or not they're working at a several billion-dollar fund, or they're working at a fund that's approaching $1 trillion, it's still to them. It's very important to their portfolio. They're going to try to make the right decision. Okay.
Brian obviously talked a lot about mobile earlier. From your perspective, what does mobile change?
I think I absolutely agree with Brian that from how someone should think about buying an experience or a customer, it shouldn't make a difference, the distinction about which device the person is on. But I think realistically, mobile does introduce new players and potentially new platforms. And so I think it's really interesting to watch how the current dynamic between, say, a Google and a Samsung play out, whether or not tensions there will mean that they invest more deeply in Motorola, come out with hardware that ultimately splinter certain mobile ecosystems. And because you ultimately want to have, I think, some fragmentation within the mobile experience. The big difference between web and mobile is that experiences have had pretty unfettered access to their consumer. They don't have that luxury necessarily on mobile. Google experienced it as it tried to deal with mobile, and when Apple was the bigger player. And so it felt that it needed to push harder, obviously, on the OS and now on hardware. So I think for it does create additional issues and challenges, but I think particularly if you see a certain amount of fragmentation, it's not insurmountable at all.
Okay. I'm going to open it up to questions in just a couple minutes, but let me just ask you first, because you cover so many high-profile internet companies.
Sure.
Let's do a quick lightning round,
okay,
where I'm going to throw out a company name and tell us something that we don't know or should know about each of those companies.
Okay.
Okay. You ready?
Yes.
All right. Facebook.
Worst call of 2012 for me. I actually had, that would probably be, I think, one of the worst calls considered on the street. We had a bullish call, I think, pre-IPO. Big problem was that Facebook was not able to sort of turn much of its data into a searchable experience. And I think when you looked at its position and leverage and strength on the web, I think it seemed like a foregone conclusion. As you move to mobile, obviously that caught most analysts by surprise. But I think the problem is potentially even a little bit deeper right now because it's so easy to create new social experiences on mobile. And you're seeing growth, internationally and even in this country from experiences like WhatsApp, et cetera, where you can even have users pay for a social communications experience versus Facebook is a free one, and it's growing faster at a similar scale. So I think those are some challenges that they face.
Google, you said you think you think social is a threat to Google.
I did, and that was when we made the Facebook call. But I think at this point, Google has done a pretty good job rectifying, I think, that threat. I think with Google, the challenge is if Android becomes more synonymous with Samsung, what does Google ultimately have to do to sort of retain control over that ecosystem? Right now, what they seem to really have in their favor, though, are killer services. And so I think whether it's a Samsung or any other partner that they're going to be dealing with, they have a pretty strong hand to play.
Okay, Yahoo and AOL, both of them publicly stating that they are intending to compete in the ad tech space.
Yeah, and I think that's an interesting point that I think I failed to sort of mention earlier. When we're talking about competitive advantage, and I think for many of you, I think it's important to start from the buyer and also both your audience standpoints, whether you work with sellers, you work with buyers, what do they ultimately care about? Your scale does give them certain advantages, maybe in terms of pricing, liquidity, yield. Your tool set obviously is important. That's an area where maybe AOL, Yahoo can compete. But where they really can't compete as well is potentially independence. And I think they say that they can, but as you bring your data sets to the experience, your learnings, I think that there is a certain part of I think when I say you, I'm speaking to the buyers and sellers in the room, there is probably a need to, or a desire to want to keep that for yourselves and not see it leveraged as part of maybe a bigger platform. And so I think independence is an important part that the ad tech industry needs to make sure that they're expressing, and they're expressing to investors.
Cool. All right, let's open up the mics. If anyone has questions, we've got one down here and one down here as well. We have a few minutes for questions for Ken, if anyone's got one.
I think there was a plan.
Let me ask a quick question while we're waiting. Or Catherine, go ahead.
Can you tell us a little about some of the misperceptions you see commonly among investors about ad tech companies?
I think that only scale matters, and that ultimately what that means is that you're going to see consolidation among the major players. And I think that it fails to recognize maybe the specific needs of buyer and seller, that there is potentially a hesitation to give too much to some of the major players. I think it's an important factor to legitimize the space for them. Yeah. Yes?
Hi. Ken, you mentioned gross margins was the interesting number that public investors were looking at. Why is it gross margins and not cost of goods as opposed to operating margins?
Because it's earlier growth, and so they really want to see that they want to see that you're investing in the opportunity. If you're looking at large addressable market sizes, they're excited about what that could mean from total operating margin and a total sort of operating profit level later on, and they're willing to take the sacrifice on an operating margin basis now in order to see that you can capture some of that bigger opportunity. So I think it's gross profit margin, but I think it's also gross profit growth. And so if you could then, and that's an important element, and I think you see that right now with Amazon, where Amazon doesn't look like it makes a lot of money, and you'll see every quarter the stock goes up, but Amazon reports no profit, and they reported that revenues came down and they missed the street, right? They did, but there was a mix shift within the business that shows that their gross profit growth is actually accelerating, and that gives investors comfort and confidence that the overall opportunity is there.
Hi, Ken.
Hi.
Do investors, or public or private investors, think about things like privacy and inventory quality, kind of the things like Brian was talking about, don't kind of annoy or creep out grandma's computer? Is that something that comes into the investors' minds from the perspective of a company's long-term kind of potential and stability?
It does, but usually it's more anecdotal. I think investors will bring it up a lot at meetings to explain why they're not on Facebook, why they're maybe not using Groupon, why they're not using other experiences, but they still need to invest in those experiences. As it starts to get into sort of an ad tech realm, they're bothered with it maybe more on a personal level, but really their job isn't to necessarily invest around that. Their job is to see how could those issues ultimately affect the consumer experience, and what impact could that have on revenues, right, on the opportunity, and whether that comes from the threat of regulation or some sort of consumer backlash. That is really only when it sort of reaches the sort of the crescendo where investors are going to focus on it to any degree. Yeah.
Hi, Ken.
Hi.
Of all the companies looking to IPO in the next 12 months, who would you rate as a good candidate for success? Is it going to be AppNexus, Cretio, or who would you put your money on?
I think I'm restricted from being able to answer that question. I think there's a compliance issue, but I would say I would be looking for businesses, again, with a strong competitive barrier and those that are basically serving the needs of their audience.
What about the ones that are public already? Who's got the most power under the hood?
I like that the companies that are public, and I think with the announcement that you made today is going much more multi-channel, and I think being able to think about it in terms of a buyer's perspective, and maybe millennial sort of falls out of this experience, but I think AOL is working in this direction. ValueClick maybe is working in this direction to some extent, but I think what you guys are doing as far as being able to think about it more from your buyer and your seller's needs. They have to think not just across one channel, not just across the web, but they have to think across mobile too. And so trying to make that sort of, sort of living within that sort of artificial distinction doesn't really serve their needs. So it's really important to be able to step beyond that and be able to address.
All right, great. Everybody here is thinking about how to build a more valuable company. Ken,
Yeah.
It's something that you're obviously thinking about a lot as well. He's going to be around today if anyone wants to ask any questions at the break or at lunch. Ken, I think we nailed it. Thank you so much.
Thank you, Michael.
Okay.
More one-arm push-ups. Okay, thank you. Appreciate it.